today we're going to quickly go through chapter 3 and chapter 4. As we went through last time, chapter 1 and 2 was going from analyze the business transaction and then how to do a journal entry. And then we went through, post the unadjusted trail balance, right? So chapter 3 and 4, we're going to go adjusted journal entry. So we have our adjusted trail balance, and then we can make a final financial statements. So chapter 4, we're going to go, how are you going to close the trail balance, right? So as well as to close the journal entry for a temporary account. So we go chapter 3. This chapter quickly introduces the adjusting process. Why do we need adjusting process, right? You probably think about it. Now we're going to talk about that. So this is kind of accounting cycle we have mentioned before. We already finished until step 4. Okay. So today we'll 5, 6, 7, 8, 9. So we're going to complete the whole accounting cycle. So first of all, the time period assumption. Before we move on to adjusting journal entry, we're going to touch base about the time period assumption, because you have to understand why there is a time differences, right? When you do your journal entry, when the cash or the revenue actually be recognized until you finally receive the money. So those are kind of a different things. That's why we need to understand, first of all, the time period assumption. The time period assumption ensures that accounting information is reported at regular intervals. It defines accounting period and interacts with the revenue and expenses recognition. Now, accounting period normally is 1 year. There are 2 different kind of things. One is a calendar year, which from January to December, or there's a fiscal year, can present anything. It's corresponding with a low point in business activity. That's why we sometimes you see a business company, financial statements. You could see the time period ended by April the 30th. So that is the fiscal ending year for the business. Now, interim periods are less than a year. We sometimes call it a monthly, quarterly, or semi-annual periods. Those are most common ones. Recognition criteria. So revenue recognition. We need to understand what is the revenue recognition criteria. The revenue recognition criteria states that revenues are recorded when earned. Okay, so revenue is earned in most cases when the business has delivered a completed goods or services to the customer. Okay, so if the goods has been delivered, completed, we have to recognize that revenue. The amount of revenue recorded equals the cash value of the goods or services transferred to the customer. We should have an exhibit from our tax book to illustrate the recognition criteria for revenue. We're also going to have examples. Revenue is earned when the business has delivered a complete goods or services to customers or clients, right? Sometimes people are difficult to grasp the concept that revenue recognition is not related to cash. It's not related to cash. We can use examples. See, if a doctor performed 3 successful surgeries during the month of December. Okay, December, the doctor performed 3 successful surgeries. The provincial insurance plan was billed a total of $30,000 on December 31st. So that is the last day of the calendar year. All right. So the doctor didn't receive payment for his services until February the next year. So according to this revenue recognition criteria, when should the doctor recognize the revenue? December or February? Okay, so you have to make sense. If the doctor has delivered the completed services, yes. When did he deliver the services? December, right? So according to our revenue recognition criteria, if the goods or services has been delivered completely, then we need to recognize the revenue. So for this kind of examples we're given, the doctor who performed 3 successful surgeries on December, even though the doctor didn't receive the payment from the government, we still need to recognize the revenue because he performed the service on December. Does that make sense? So even though the doctor didn't receive the money until February the next year, as long as the doctor completed the service on December, we need to recognize the revenue on December. So that is the revenue recognition criteria for revenue. Now the recognition criteria for expenses, that is the matching objective. What is the matching objective? Right there. So matching expenses incurred with revenue earned during the accounting period. And expenses, sometimes we call like a sales commission with a later link to revenue will be matched against the revenue period. We're going to see the examples pretty soon. Okay. Now, so this is kind of have a detailed introduction about matching objectives. This matching objectives to help people determine when to recognize expenses, right? Identify all expenses incurred during the accounting period, like prepaid, even though you hasn't paid cash yet. If the expenses happened during December, then we have to recognize that expenses on December. Even though we haven't spent the money until the next year, we still need to recognize it. And then matching objective measured expenses, and also expenses always matching against with the revenue earned. Okay, so keep that in mind. Whenever there's a revenue recognized, there are also going to be expenses should be recognized during the same period. Okay. Some expenses cannot be easily matched to revenue, like rent or utilities. It's very hard to recognize the utilities according to the revenue. So those types of expenses, we just simply match to the time period. So we're going to take a look at examples together. Number 2 questions. Why can we wait to record transaction until the cash comes in or the cash goes out? That's going to be 2 different accounting methods we're going to mention. First of all is accrual-based accounting. And then the second is the cash-based accounting. Normally, we talk about accrual-based accounting. Accrual-based accounting is exactly match the 2 criteria we just talked about it. One is the revenue recognition. The second is the matching objectives. Okay, so that works with accrual basis accounting. In accrued business accounting, the accountant entered the transaction when the business performed services or incurred expenses, not when cash has been received or paid. You may think about account receivable. Okay? If the company or if the business sell the product, we start recording, even though we didn't receive the money, we sell on account. So we debit account receivable, right? And credit our services. So that is the good examples for accrued accounting, because even though we didn't receive the cash, we still recognize the account receivable as our revenue. Now, for cash basis accounting, of course, is whenever there's a cash involved, we start recorded, we start to recognize the revenue. If there's no cash received, we're not doing anything. So that is a cash basis accounting. Normally, the cash basis accounting apply only to very small business, maybe 1 employee or not too many transactions going on. So they've been using cash basis accounting, but mostly we use accrual basis. And also accrual basis is the one we are studying our financial accounting course. Now, objective number 3. This is the kind of the thing, prepare adjusting entries. Okay, what is the adjusting process and why it is important? Now you wanted to pay attention on this part because you will see the final exam to talk about. They want you to do to prepare a adjusting entry. It's very straightforward. There are only 5 types. Okay, so we're gonna go through that 5 type adjusting entries. If you're, because I have students, because you know our course is in a very short time and there's so much information going on and they cannot remember or quite fully understand everything, like 100% understand everything. So I would recommend you guys to memorize it. Okay, even though you're not fully understand, but memorize it because, for example, the adjusting entries, they're just the 5 types. Whenever you see those 5 types going on there, simply list it as a journal entry. Now we're gonna go through the 5 types. Now the 5 types will organize into 2 groups. So one is a prepaid, another is accruals. We're gonna talk about each. First of all, under prepaid, we have prepaid expenses, we have amortization, we have unearned revenue. So we're going to talk about prepaid expenses first. Prepaid expenses or deferred expenses. This require adjustment because the cash is paid in one period, but the resource is not completely used until a later period. Okay, the examples we can provide is like prepaid rent, prepaid insurance, or supplies. The examples we'll be using in our tax book is supplies, I believe, or prepaid insurance as well, because it's so common situation, right? Even though when you purchase your car insurance, not for personal use, but for business, sometimes they purchase the insurances. They always spend one-time insurance for a whole year. So we probably purchased the insurances on January 2022. And then every time when the time goes by, we recognize that expenses. If that makes sense, because you spend maybe $12,000 on January. That is a prepaid expenses. This $12,000 will be equally applied to each month when the month passed. So when January passed, you recognize the 1 month's expenses has been realized, right? When the February passed, you need to recognize 2 months' insurance expenses. When there are 3 months past, March passed, you need to recognize 3 months' insurance. Why do we need to do adjustment for accounting record? Because the accounting record, you probably didn't purchase the prepaid insurance on January, probably purchased on August. Then on December, you purchased for a whole year, right? But until from August to December, there are only 4 months passed. 5 months. 5 months passed. Then you still have something left for the next year. Then on December, when you need to do a financial statements, you need to recognize those expenses has been already realized, right? The 5-month insurance because the 5 months passed. So those 5 months insurances has to be recognized. That is the reason we need to do adjustment in order to get an accurate number for our financial information at the end of the year. So we'll see examples together. Prepaid insurance examples. So insurance policies are usually paid for in advance. So the examples were already given. May 1st, 2019, HEC purchases an annual insurance policy for $3,600. The journal entries will be debit, prepaid insurance, credit, cash, right? We already know that. Then after 1 month has passed, adjusting entry on May 31st, because it's already 1 month, we use 3,600 divided by 12 months. So each month will be $300. So whenever there's 1 month passed, we have to recognize that expenses. So we debit insurance expenses, credit, prepaid insurance. Now pay attention, prepaid insurance, we treat it as asset. We treat it as asset. So whenever there is expenses coming, we decrease on credit side. That is the prepaid insurance. So we'll put it into a T account to make it easier to see. Now, prepaid insurance is an asset account. So when they increase, we put it on the debit side. So on the left side, right, $3,600. And whenever their expenses happened, we know expenses happened is on the debit side 300. We have to deduct the prepaid insurance 300, which leaves our balance with $3,300. That is our prepaid insurance after 1 month. Supply example is very similar to supplies. Supplies is the same thing. Like when you start your new year, you always purchase a bunch of office supplies, right? But when times goes by, you use some of the office supplies. You need to count it, and the rest of the parts you have to record it. So how much has been used, you have to record it into your journal entry. So that is the reason you need to make adjustment for supplies. Now, May 2nd, 2019, HEC purchased supplies for $1,500 cash. Now the journal entry, we need to record it with debit supplies, credit cash. Then May 31st, after 1 month, a physical count of the supplies indicated that $1,000 remained, which means we have been used $500 during May. So we need to do adjustment at end of the May. That is, we increase our supplies expenses, right? Because we have to recognize that $500 expenses. And then we decrease our supplies, decrease it $500 because those has been used. So supplies is under asset account. When we put into a T accounts to have a better understanding, now we first of all will spend cash to purchase $1,500 office supply. And then after 1 month, we used $500. So we have to deduct $500 from the total $1,500, which leaves our balance is $1,000. Okay, that is the supplies examples. Now just simply memorize it if you kind of in a hard time fully understand everything. The debit, prepaid insurance, credit, cash. Whenever you need to do adjusting entries for the prepaid insurance, you debit insurance expenses, credit, prepaid insurance. Now amortization of PPE. Just pay attention, PPE it is applied to the property, plant, and equipment, right? Because they have a residual value. We always see the useful value for a building, maybe 35 years. Or furniture's been good, the useful life is for 10 years. So that's kind of the values we have to deduct it, we have to divide it. Then we could calculate the allocation of the total costs. I'll see examples all together. Now amortization. Amortization is the allocation of the cost of a capital assets to expense over its useful life. The examples have been given. Amortization is very similar to prepaid expenses that the asset is recorded when the plant or equipment is acquired. At the asset is expensed as it's used. So very similar to the same thing comparing to the prepaid insurance. Now we'll see examples on May 3rd, 2019. HEC purchases furniture for $45,000 with expected life of 5 years. So we know that directly from here, every year we need to do a amortization adjustment. Okay, we use $45,000 divided by 5. Now just simply on May 3rd, we need to record a journal entry that we spend cash $45,000 and debit the furniture $45,000. So this is a T account shows. Then a portion of the future cost is transferred from the assets account to amortization expenses account. That is after 1 year, we need to recognize the amortization costs. Now for our examples, it's not just for 1 year, it's just for 1 month. So we use $45,000 divided by 5 years. That is our $9,000 per year. Then we divide by 12 months. So $750 per month. So from May 2nd to May 31st, there's only 1 month passed. We debit amortization expenses, right? We have to recognize that expenses, and then we credit a different contract account, accumulated amortization. Just simply memorize the accumulated amortization. That is a asset account, but with a credit balance. We have learned there's a normal balance. Remember from the last course, chapter 2, the normal balance is, which is a account with a normal balance that is a debit balance. But accumulated amortization, this is a very special account. So that is a contract account which is corresponds with the assets, because instead of reducing the asset account, we just simply use this accumulated amortization to better do the recording, or better have a better deep, like easily understand about why the total assets value decreased. It's because there's accumulated amortization, or there's amortization going on there. So it's simply debit amortization expenses, credit accumulated amortization. Okay, simply for 1 month. That is the contract account, is a company account. For example, the accumulated amortization corresponds with the PPE assets, right? So that is the property, plant, equipment assets. There are only, I think there are simply 2 contract accounts we're going to talk about it. One is the accumulated amortization, another one, oh, I forgot another one. It's coming back. Okay, it's going to come into my mind. We're going to talk about it in chapter 6, I believe. So simply remember this. The accumulated amortization account is a normal credit balance with a normal credit balance. So when you take a look at a T account, we spent $45,000 to purchase the furniture, so on the debit side. And then accumulated amortization decreased $750 because it's the asset account. When they decrease, it goes to credit side. Then amortization expenses increase is reported on the debit side. Okay. Now the book value. The book value, we use the historical cost total amount, $45,000, deduct the accumulated amortization, $750. So the net value of the furniture will be $44,250. You're not going to require to do the calculation, but it just helps you to have a better understanding about how the accumulated amortization works in the balance sheets. This is kind of a partial balance sheet. Oh, there you go, actually. So here is the partial balance sheets of the HEC. You could see that we have our original total cost, $45,000, and deduct the accumulated amortization, which leaves a net furnitures costs plus the net cost. This is our total PPE value, or total costs. Okay. Unearned revenue. So that is the number 3. This is the number 3 special accounts we're going to talk about for unearned revenue. Unearned revenue arises when the business receives cash in one period, but does not earn all of it until the next period. Sometimes, like if you're on a catering business, their other business always order the catering services from you. For example, December for New Year's party. If company gonna hold a New Year party, then they will order the food on early December from you, right? They will give you a bunch of money, maybe $10,000, and saying you're gonna provide this catering services for us on January the 1st. Then you receive the money, but you hasn't provide the service yet. We have talked about that. If you haven't provided service but received the money, this money cannot recognize as revenue. This money will recognize as liability, because even though you receive the money, but you haven't provided the service yet, so you owe your customer the duties or the services, right? So that is the unearned revenue. We treat it as a liability. So how we're gonna do if there's unearned revenue happen, how we're gonna report it in our journal entry, and how we deal with the adjusting entry. So HEC received the cash advance of $3,000 on May 20th, 2019 for a customer for 30-day project. So this is a 30-day project. $3,000 has been received already. but we hasn't provided the service yet. So that is a liability, right? So the cash increased $3,000 and liability increased $3,000. When liability increased, because go credit side. So debit, cash, credit, unearned revenue. Then after 10 days passed, right? End of the May. So the 10 days already passed. We need to recognize that revenue, right? So see, there's $3,000. We already been is total 30 days and 10 days passed. So 10 out of 30. So that's 1 out of 3, which is 3,000 times 1 out of 3. We have to recognize the $1,000 revenue. Now, the adjusting entry will look like liability decrease 1,000. Liability decrease gonna go debit side. So we debit our unearned revenue, credit the service revenue. When revenue increase, it goes to credit side. Remember the hands-on? That is how that works. So whenever there is unearned revenue, we need to recognize the unearned revenue to the adjustment. We debit unearned service revenue, credit service revenue. Clear? Question? No. I'm gonna keep going. Okay,
Yeah.
perfect. So I'm gonna keep going then. So unearned revenue is the liability. We already know that. Whenever there shows up in the T account, the total amount will show on the right side, right? Credit side, $3,000. When there's $1,000, need to recognize that revenue, it goes to the left side, which is debit side. On revenue, this is the balance coming from the very first journal balance, right? So we're not care about that. Then just wondering about May 31st, there's $1,000 on our revenue services being recognized. So we put on the credit side. So the total balance for the service revenue will be 26,500. That is how that works for adjusting journal entry for unearned revenue. Then the fourth will be the accrued expenses. Accrued expenses, you often see this because it's kind of a salary related closely. For example, if you get paid bi-weekly or bi-monthly, right? So every time you been paid 15th and 30th. Unfortunately, 30th is Saturday. So we're not gonna get paid till January the 1st, which is the first. Then, because it's already past the date, the salary hasn't been paid out, right? So I have to record adjusting entries for that salary payable, which is liability. So remember, accrued expenses, we treat it as a liability. Okay, unearned revenue is liability, accrued expenses liability. Now we see this examples. HEC pays to employee by monthly salary 4,000 in total on 15th and on the last day of the month. The employee are paid on May 15th, but May 31st is Saturday. So that's employees will receive their paycheck on Monday, which is June the 2nd. Now we need to match the salary expenses to the period with a journal entry. May 31st, we recognize the salary expenses, which is 4,000, but we hasn't paid yet, right? We owe them that $4,000. We hasn't paid our employee yet. Then we credit the salary payable because that is a liability. So the liability increased. Now, after posting, salary expenses, salary payable contains the complete salary information for the month of May. Then on June the 2nd, when the salary has been paid, we have to deduct our liability salary payable and also deduct our cash from asset account. So this is our when the liability has been paid off. But whenever there is a payable salary involved in the question, you know, the journal entry will look like this. We debit salary expenses, credit salary payable. Okay, so that is the adjusting journal entry whenever there is a salary expenses or accrued expenses happen. Now the next one will be accrued revenue, which is like an interest revenue. So that is the revenue has been earned but not yet invoiced or connected Since it's been at the revenue recognition criteria, we already talked about it. So whenever the revenue has been earned, we have to recognize. Right? So examples, HEC hired on May 15th to provide monthly service for $3,000 per month, with the first payment to be received on June 15th. Services provided from May 15th to May 30th. Now we have the adjusting entry on May 30th to record the 2 weeks of revenue. With debit account receivable, $15,000, $1,500, and credit service revenue, right? Because this is our service revenue. We received the money first. You can see that this is kind of a vice versa journal entry according to the prepaid insurance. Prepaid insurance is on the standpoint of purchase that insurance, right? But this accrued revenue is a standpoint of the insurance company, okay, which is received the money first but hasn't provided service yet. So when time passed by, account receivable, there are 2 weeks of revenue we'll have to recognize. We use $3,000 times 1/2. That's just half of it. So we debit account receivable, credit the service revenue. Okay. Now, when you go to the T account, similar balance sheets for account receivable 14,000, and then revenue. We recognize the revenue on the credit side $1,500. So the total amount will be $26,500. In summary, each adjusting entry adjusts an income statement account. So either revenue, remember, or expenses. No adjusting entry ever down to the cash balance. So if you see a question, they ask you to do a adjusting entry. You focus on the 5 different types. Okay, just searching for the 5 different types. Never do adjusting for cash account. You will see the examples from your textbook. We'll just pause for 1 second. Okay, now, so we keep going with the learning objective number 4. After we have prepared a unadjusted trial balance, and then we finish adjusting journal entry, now we could be able to do a adjusted trial balance. The adjusted trial balance is prepared after the adjusting entry has been journalized and posted, right? And then the adjusted trial balance services as a basis for the preparation of financial statements. So we're going to do, how do we prepare the financial statements? Even if you have finished the adjusted trial balance, then all the numbers just directly goes to the financial statements, right? We always prepare income statement first, and then owner's equity second, and then balance sheets the third. Now we're going to talk about the financial statements. Financial statements are prepared using account balance fund adjusting trial balance. Income statements is prepared always first, followed by the statement of owner's equity, and then the balance sheets. Now, should have examples for that. Relationship among the 3 financial statements. Income statements. I think we went through this. Anyway, the income statement reports net income or net loss, which will use the number to calculate the owner's equity's ending balance. Now, capital is a balance sheet account, so the ending balance in the statement of owner's equity will transfer to the balance sheets. So this is the picture to show exactly how that works. When we finish the income statements, so the net income will come to the calculation to the ending balance of the capital. Then the ending capital balance will directly go into our balance sheets to make sure that total assets will equals to the liabilities plus owner's equity. So you will see the questions from your final exam. It will ask you to give you the adjusted trial balance and ask you to prepare a balance sheet. So pay attention to on this and how to do a balance sheet. Okay, you should be given a template of a balance sheet. So you just simply put a number in. You might need to do a little bit calculation because the owner's equity parts. So make sure that you understand how you do the calculation. If the net income has been given, okay? Pay attention to that part. You will need to do a balance sheet during your exam. Now, the last one is the ethical consideration in accrued account. Very easy to make an unethical decisions for the business managers or executive team because they could overstating the revenue to make their financial situation beautiful or good for investors. Okay, so they could simply overstate their revenue, understate expenses to make their financial statements better. So that is kind of very easy to make unethical decisions. The last part for chapter 3, as we talk about it, is comparison between the ASEP and IFRS. So the based on during the revenue recognition parts, there are no process differences between ASEP and IFRS with respect to adjusting entries. So they're the same, no differences. But you could definitely read the detail in the textbook regarding the two different accounting procedures. Okay, so that is for chapter 3. And now we quickly move on to chapter 4, because chapter 4 is the last 2 steps to closing the accounting cycle. So first of all, this is going to be a quicker, even faster chapters for chapter 4, as though it's the same thing, very similar to the adjusting entry. Closing entries is always being those 4. So if you have a little bit hard time to fully understand everything, try to memorize this because you will have to do a closing entries during your final exam. So now, first of all, is the accounting cycles. We've been talking about it, right? The last last 2 steps. We need to journal and post the closing entries and prepare the post, which is the closing trial balance. The accounting worksheets. The accounting worksheets, we actually have examples from our textbook. It's a optional tool, so it's not necessary. If you have been working with the accounting company or you've been working with the accounting team in the big company, you probably didn't see these worksheets before, but it's just a good examples, a very convenience to show that all the account in the adjusting and the closing process. So we have that examples. One of the biggest thing is the worksheets will give you a visual parts of total debits equals to total credit. If it's not equal to each other, there must be something wrong. Errors happened. Here we go. So this is our examples coming from our textbook. We began the worksheets began by listing the accounting title, always on the left side, and then enter the trial balance directly into the first columns of the worksheets. Then we enter the adjusting entries in the next 2 columns. So those are the numbers that's already been down, right? So you know exactly, for examples, the adjusting entries for accounts receivable, they're $1,500 on the debit side. So you make changes right there. Now, do not pay attention again. There's no adjusting happened to cash account, right? So you could see under adjustment, there's nothing will go to cash account. And whenever there is adjusting happened, you just simply put a number into that worksheet. So when you finish all the enter the numbers, you can calculate it at the very bottom. See, the total debit is always equals total credit. See, the total debit always equals to total credit. Now, for net income is entered in the debit column of the income statements, okay? And in the credit column of the balance sheets. But net loss will be entered in the credit column under income statements and the debit column under balance sheets. So that is how that works. That will make the balance will equal each other. Okay. Let's pay attention to that part. Sometimes students put it into a wrong spot. But you won't see this in your exam or assignments. Probably in your assignments, but not in the exam because it's going to take a little bit longer time. I haven't seen this in my work before, like the worksheets, because people are using, you know, the SAP mostly or the QuickBooks, like computerized accounting system. So it won't need, we're not, as I know, we're not using manually recently. So there's no way I could see people are using like a worksheets to do it, but it's just the tools to help students to have a better understanding about what it's talking about. Right. So completing the accounting cycle, the worksheet helps to organize accounts data, record adjusting entries, compute net income, prepare financial statements, and then close the account. Okay. Now, how are we going to record closing the account? Closing the account is the process that certain accounts are prepared for recording transaction of the next period. So we're closing the temporary account. How are you going to do that? What is the temporary account? Let's see from here. Temporary account is like revenue, expenses, withdrawal, and income summary account. Those are all temporary account. Permanent account, which is assets, liabilities, owner's equity. Those are not closed at the end of the period. It's going to carry over for the next period. Okay, so we only need to close revenue, expenses, withdrawal, and income summary. So memorize that revenue, expenses, withdrawals, and income summary needs to be closed. Now, how are we going to show? We close the revenue into income summary. So we debit revenue, credit, income summary. We close expenses into income summary. So we debit income summary, credit, expenses. Then we close the income summary. The balance of income summary equals net income or net loss. Now we transfer to the capital account. So we debit income summary, credit, capital. Then we close withdrawals and to capital. We debit capital, credit, withdrawal. Those are the 4 journal entries you need to make if there's a requirement for closing the accounts. Okay, so we close revenue into summary, expenses to income summary into capital, and then withdrawals to capital. And then that's it. Pretty simple and straightforward, right? So never close permanent account, right? Assets, liability, and owner's equity. Those are going to carry over to the next period. How do we fix accounting errors? We didn't talk about that. I think, last time we talked about how to detect if there is accounting errors, right? We divide by 9. If it is evenly divided, then there must be some errors happened. We need to check the journal entries to find out the wrong numbers. Now, how are we going to correct in the journal entries? We have examples right there. HEC paid $10,000 cash for furniture. An incorrect entry was made because it's furniture. We should debit furniture, credit cash. But then the accountant recorded as debit office supplies, credit cash. Right, so that is bought the office supply instead of furniture. Then there are 2 approaches to correcting this entry. The 2 approaches. Now the first one, we need to reverse the original transactions from office supply back to cash. So our cash will go back $10,000 and office supply decrease $10,000. And then we record the correct journal entry with debit, furniture, credit, cash. This method is kind of quite steps to do, right? Quite a lot of steps to do, but it gives a very clear audit trail. Easy to read. And this is kind of a history and easy to read that will figure out what happened. So if there's auditors come in, internal auditor or external auditors, when they see those journal entries, they know exactly, oh, so that was run recording office supply into furniture into office supply. So that's why we need to reverse the run journal entries and then record the correct journals again. So that is the first approach. Second approach, to simply change whatever the affected accounts. So simply debit furniture, credit, office supplies, easy one, but it didn't give a clearly trail. So whenever if there's an auditor come in, they probably question it, saying that why furniture has been purchased and then by decreasing the office supply, right? They're trying to figure out the situation between those two. So this is kind of the things for auditors to do. But the first approach always been done by the computer system. If you just directly recorded the second approach, is not that clearly to give explanation to what was going on. Now, the next one, we're going to talk about how can assets liability be classified for more informative balance sheets. Assets and liabilities are classified as either current or long-term based on their liquidity. Okay? Liquidity is the measure of how quickly the item may be converted to cash. Now we'll talk about assets first. Asset, current assets also sometimes refers to a short-term assets. This is including cash or other assets that will be converted to cash, sold or consumed in 1 year or one operating cycle within 1 year. The operating cycle is the length of time during which cash is used to acquire goods or services, or these goods or services are sold to customer who pays for the goods or services with cash. Examples for current current assets, sorry. So cash, account receivable, notes receivable within 1 year, supplies, prepaid expenses, inventory. So those are good examples under current assets. Long-term assets, that is not classified as current. So they're including a PPE, goodwill, intangible, long-term investment. Okay. So those are assets. Now liabilities, current liabilities are debt due to pay within 1 year within one operating cycle. Examples like accounts payable, notes payable, salary payable, tax payable, interest payable. So it's very easy to remember, right? Well, as long as there's a payable coming in the term, those are liabilities. And then plus unearned revenue. Okay, so that is the revenue has been recognized, but services has not been delivered. Long-term liabilities like a long-term notes payable that is due after 1 year. So to classify the classified balance sheets, there are two different formats. The first format is account format, which is assets listed on the left side and liabilities and owner's equity on the right side. The next format is the report format. So the assets at the top, liability and owner's equity at the bottom. The only differences between those two is the format. So you are good to go use whatever you prefer. Sometimes the different companies will prefer a different format. So just pay attention to those. But for me, if you're taking the classes or doing some exercises or practices, both formats work. The next one, how do decision makers evaluate companies in current ratio and debit ratio? Ratio analysis is one of the most important tools to analyze a company's financial situation. So the current ratio and the debit ratio are very commonly used ratios that will allow the comparison against other benchmarks. So we'll talk about current ratio first. Current ratios, we use total current assets divide by total current liability. The higher, the better. Okay, so the current ratio measures the current assets to current liability to help the financial statements user to assess the company's ability to pay current liability with their current assets. So that's basically simply to say that to measure if the company has enough current assets to pay off their debts. Okay. So the ratio is higher, the better for current ratio. Pay attention to that ratio because you're going to do the exam questions based on the current ratio. They will ask you to prepare a balance sheet. When you finish your balance sheet, you use the number to calculate the current ratio. Debit ratio. Debit ratio compares the total liabilities to the assets. Right? It shows how much of the company's assets are financed with debt. So it's just vice versa. We use total liability divided by total assets. Pay attention, it's total assets and total liabilities, not current. Right? Because the numbers will be different. Now, generally, higher current ratio is preferable to a low current ratio. A low debt ratio is preferable to a high debt ratio. That's the two different ratios. Now, the last one for chapter 4, the same thing, to compare the, before we move on to that, I want to say that financial ratio analysis is the most helpful tools when performed for a series of periods. So you never see the company will ask you to do a financial analysis by using 1 year's ratio analysis. They always give you a 4 or 5 years, or they give you the current year of the company and also a company from a benchmark. So the benchmark company, so you can do the comparison, right? You cannot just tell how the company's doing by just calculating one ratio. So the last one is the comparison between IFRS and asset. The accounting cycle is the same under IFRS and asset. The presentation of information may be quite different as detailed in this template. So if you're interested, you can definitely read on your own. But for right now, the accounting cycle is exactly the same under the two rules. Okay. So I think that's it for today's chapter 3 and 4. Any question? Nope. Good.
No, thank you.
Perfect.
Yeah.
Thanks for coming. I will stop recording.